Here we go, guys. In today's video, we're going to cover a great article by Investopedia regarding the timeline of the U.S. stock market crashes 1792 to 1907. And some people, might ask, why are we even looking at that? What does that have to do with us now? Well, you're going to see a lot of similarities and correlations to those stock market crashes to what has happened, in more current history in the U.S. regarding our banking policies, uh, trading on margin, and collusion to rig markets. Okay, guys were doing that. Hey, we weren't the first. Okay, guys were doing that back in late 1700s into the 1800s. Also, you may not know it, but before 1929, the big stock market crash and then the depression afterwards, we had four depressions previous to that, and one of them considered a Great Depression. We had a gold market collapse, a recession, and a real estate bubble before, the great uh, stock market crash, which I believe was so far, the biggest ones yet in history of the U.S. So let's get started. Okay, the first stock market crash took place in March of 1792, and here we go. Back in the United States, overexpanded its credit creation. Okay, and then that led to easy money, and then that easy money, put that money into bad investments, and of course, it didn't work out too well. And then Alexander Hamilton tried to stabilize U.S. markets by granting or talking to many banks into granting discounts to those that needed credit. Because the world doesn't go around until we get credit, for businesses and loans and things of that nature. And in addition, of course, they're going to put numerous policies in place and other measures that help stabilize those markets. Then in 1819, I keep wanting to say 19, but this is 1819, collapse in cotton prices, credit contraction and over speculation, and land commodities and stocks. Here we go again. We ended up with America's first Great Depression, 110 years before the next Great Depression. And this one that started in 1819 finally came to an end in 1821. And then Panic at 1837. I bet hardly anybody knew this. We had a real estate bubble because of erratic American banking. And then Andrew Jackson, he could have curtailed this, slowed it down, but for whatever reason refused to extend the second Bank of the United States charter, and that enabled state banks to give out banknotes and money, just hands over fists, which is never a good deal. And of course, that led to a major economic depression that endured for 6 years. In the next group, we go to Panic of 1857, and this was mainly failure of an insurance and trust company, and which led to the New York bankers putting restrictions on transactions, and in turn resulted in panic selling. And bank closures and depression soon followed, the latter which lasted 3 years. And then we had our first Black Monday occurred, September 24th, 1869, and saw the collapse of the gold market. Now, why did that happen? Well, we had two guys, two speculators, Jay Gould and Jim Frisk, and they concocted a scheme to drive up the price of gold. Then they recruited this guy, Hannibal Corbin, who convinced President Ulysses S. Grant. I mean, that's pretty bold to try to, get a president to buy into something. But of course, as I said that, how many times has that happened in, our recent history? People trying to collude with the president to shape the markets. But anyway, they were trying to, limit the metals availability. Of course, supply, demand, you know how that goes. Less supply or less supply, more demand, the higher the price. However, President Grant, man, he was a stud. He didn't go in with that, and he ordered the sale of over $4 million dollars in government gold, which of course, brought the market down. and collapsed the market. And one of the reasons being that the market collapsed was many had taken out loans to finance. So there we go, working on margin again back in 1869. Anyway, they couldn't, left without any money, couldn't pay back their debts. And then the Panic of 1884, failure of a small number of and this is mainly all in New York, a number of financial firms in New York, mainly the Metropolitan National Bank, had a closure, and then that kind of, ducktailed into, other banks, but it was largely contained in New York and fortunately swiftly ended. And then we go to the Panic in 1893. Hey, it just seems like it's happening again, again, again. And here we go. A run on gold in the U.S. Treasury slowed economic activity. And of course, when you slow economic activity, you have unemployment, and then your asset prices plummeted because, there's not people out there supporting the markets. And then when the prices come down, you get panic selling, and it caused one of the most severe depressions in U.S. history. Okay, there we go. 1896. It was basically a continuation of the 1893 depression. We had a little pause there, and the U.S. economy fell. Then the U.S. economy fell into another recession in late 1895, and then it wouldn't fully recover until mid 1897. And then we're getting, close to, the 1900s here, the Panic of 1901. Panic occurred largely, and this is, I mean, funny and sad at all the same time, a struggle between Jacob Schiff. Here we go, J.P. Morgan in the house, James Hill and E.H. Harriman over the Northern Pacific Railroad. And it looks like it appears everybody was short that was caught up in that situation. And then the price skyrocketed. I wonder how that happened. Okay, a little manipulation there. And then that had a trickle waterfall effect, causing stocks and bonds to drop. And the panic in 1901 ended when these guys, I guess, sat down, had a beer and a truce, and because they were, I would imagine they were all hit hard. So that's the main reason. I guess no one could really take out the other, at that time. And then the last big one before 1929 was the Panic in 1907. Were spurred. This is very, very important. Okay, this is like crazy important. Were spurred the monetary reform movement that led to the establishment of the Federal Reserve System. Oh my gosh, commonly referred to as the Fed, and it was followed up, by a failed attempt by Hines and Morse to corner the stock of United Copper. Okay, there's always some, sort of collusion and guys trying to, control things and make more money. Obviously, several banks associated with these two guys succumbed to runs by depositor. Well, yeah, as soon as they found out it was a scam. Everybody wants to, and those banks were involved. Everybody wants to take their money out. And then we had the great J.P. Morgan come in, save the day. I believe what happened, he came in and backed all that up with a huge amount of money and possibly prevented the New York Stock Exchange from being closed permanently. And which brings us to the 1929 crash. And as we studied before, it lasted until 32, resulting in the Great Depression. And this is very important. I mean, stocks nearly lost 90% of their value, and we didn't fully recover until November of 1954. And the main two triggers was the governors of the Federal Reserve Banks and Federal Reserve Board to try to combat market speculation. And then we had a major expansion in investment trust, public utility holding companies, and I think this is really the straw broke the camel back, margin buying. Okay. So there you go, guys. I appreciate you watching. Give us a follow on Twitter. Check out our Patreon, and we will see you on the charts.